I was taught to be a contrarian. When everyone's running one way, run the other. That you never make money by following the herd. Buy from pessimists, sell to optimists. Um, and that has really stuck with me. And that's really what led me to the RV space.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show and get some great value for your investing goals, make sure you leave us some honest feedback with a rating and review. It helps us, and it also helps other listeners find this show. And listen, if this is your first time listening or you just haven't done so already, make sure you hit that follow or subscribe button so you don't miss an episode. We got a great show today. We're going to be talking to Ben Spiegel. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Ben Spiegel is the co-founder of Redwood Capital, a premier real estate investment management firm specializing in sourcing and managing institutional quality, undervalued commercial real estate investments. Now, Ben leverages his multifaceted expertise in real estate, finance, and law to build, operate, and sell luxury RV properties, generating outsized returns. Let's welcome to the show, Ben Spiegel.
Hey, thanks so much for having me. I really appreciate it.
Yeah, absolutely, Ben. Great to have you on. Listen, I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, absolutely. So I graduated from Syracuse University back in 2011, was lucky enough to go right to the buy side, worked at Barclays Capital in high yield capital markets, was there for about a year. Was tenacious enough to be able to land another good job at a boutique special situation credit opportunities hedge fund, Cedarview Capital, managing about 250 million. Did a lot of leverage loans, high yield bonds, which is just really lending to private equity owned smaller companies. Was there for about a year and a half. And that's when I transitioned to a larger special situations hedge fund called DG Capital that has close to three quarters of a billion under management. My expertise really expanded more into bankruptcy and distress, corporate restructurings, loan to own situation, buying second lien term loans of like Bullmore AMF at 30 cents on the dollar and forcing them into bankruptcy, kicking out management, bringing new management in, restructuring the capital structure and putting a new business plan in place and having them emerge. But while I was at DG Capital, I moved there in 2014. I was about 24 at the time. Now I'm 35. Is when I bought my first small building. I always had a rule. I always wanted to put my money into bricks because I knew I couldn't take it out. So I started buying very small multifamily buildings right north of New York City in Mount Vernon and Yonkers, which are the two cities that border New York City to the north. For example, the first building I bought was 4 1 bedrooms over a deli that I paid $250,000 for, put 60, 70 grand down, borrowed like 180 from the bank, and did that every year for 5, 6 years, sometimes did 2 buildings in a year. And after about being at DG Capital for 5, 6 years, I got a call from Signature Bank, which I'm sure most people or some people know doesn't exist anymore. They went bankrupt a couple of years ago. They were used to be the premier lender in the area, that they had come into possession of they took possession of a loan, a non-performing loan that was cross-collateralized by around 150 to 180 apartments across 10 buildings, and they wanted to get it off their books. So they asked me if I would be willing to buy it. They wanted around 100 grand a unit equivalent for the note, so about $16 million. I knew at that time I would have to take out something called note on note financing, which for about 8 or 9 million, and raise another 8 or 9 million of equity. But I knew that I could not, I was working 10, 12-hour days at this hedge fund, and I could not do both at the same time. So I really took a leap of faith and decided to leave my cushy Park Avenue buy side job and went from, penthouse on Park Avenue looking at a Bloomberg terminal to, rolling up my sleeves and knocking on doors in precarious areas to try to, turn around these buildings.
Man, I appreciate that context, man. You talked about leaving a penthouse on Park Avenue. I mean, just envisioning that to, go out to Mount Vernon and Yonkers to knock on some doors and look for opportunities and chasing that rent money is certainly a picture. To give a little context, you talked about, graduating from Syracuse, getting on the buy side. For those folks who aren't in finance, they may not fully understand that. So I'm gonna have you explain that in a moment. But you were at Barclays, you worked at some different companies, started to scale up some of the, roles you were playing, focusing more on kind of bankruptcy. You called it the loan to own, where you're now loaning money to put yourself in a position to take over these assets. And that's where you really started investing in these kind of smaller multifamily properties. And then you got to the point where that bank, called you to say, hey, we've got this portfolio, we've got these properties, we want you to take them over. And that kind of forced you or kind of led you down the path to say, okay, I want to do this, but this is going to require my full attention. I'm going to have to leave that cushy job. Just on the buy side, just for those folks who, maybe don't understand the finance world as much, can you just elaborate or clarify a little bit about what you mean when you say that?
Yeah, so but any kind of investment bank is considered sell side. The buy side role is working for any money manager or invest someone that actually manages capital for individuals, institutions in a pooled manner. It's a pooled vehicle. And the mandates, luckily, the mandates where at the funds I worked at were extremely broad. I touched on the word special situation multiple times. Uh, in my opinion, really, what a special situation and I want to just make it clear, I do not have a career of investing in public equities. I do not like the public markets. I do not trust the public markets. I need the equivalent of inside information on the public side, but there is no such thing as inside information on the private side to be able to make an investment with the confidence level that I'm going to be able to generate the returns I need to make it worth my while.
Yeah, I appreciate that. You mentioned that Signature Bank called with this opportunity. What led to that? I mean, did you just have a relationship? Were they watching what you were doing? Like, how did that come to be?
Yeah, so they were the only bank I had lent from for the previous 6, 7 buildings, and they were all those other buildings were in Mount Vernon and Yonkers. Ironically, so it made sense. And this was much bigger than anything I even thought of. The biggest building the largest acquisition I had done at this point was maybe $1 million, and they just happened to. I mean, no bank wants to take ownership of buildings and want to get it off their books because it doesn't look good for their balance sheet, nothing to have a non-performing loan ratio, but whatever. But so I had established a relationship with them as a lender, and I also think it's worthwhile saying I started working with young brokers to buy these buildings all off market that were about the same age as me. And I can't emphasize enough in this business, your net worth is your network. Your Rolodex is everything. It's a little bit what you know, but it's a lot of who you know. And now, like, you have to, in my opinion, you have just a very large competitive advantage if you're the one getting that first call on an opportunity. Because I mean, brokers really have two business models. One where they get a prospective seller that wants to squeeze every penny out of the deal. They put together a pretty investor presentation, and they'll blast it out to 5,000 people. But every now and again, they come across a special situation where there's a forced seller, or a seller that, for whatever a myriad of reasons, does not want to sell on market, and they value something called certainty of close. They are okay taking a below market price as long as they know the person they engage with will close the deal.
I love it, and I think that is so important. And the other insight I'm taking away from what you just said is the relationships are key. One is the broker, right? You talked about coming up with the same, similar age with those brokers, similar experience. If you're new, find those brokers who are new, who are willing to roll up their sleeves and hustle with you to find these deals, find those opportunities. Because as you all kind of grow, you're going to be the first call for those individuals. So that's huge. The second thing, though, was you mentioned that Signature Bank was the only lender you really worked with up to that point. So you had established credibility there. You had established track record. Even though this deal was far outside the types of deals you had been doing up to this point, you had earned their trust and had built a positive reputation where they felt comfortable bringing you a deal that was really beyond what, maybe you could or should have been doing at that time, but they had the confidence based on what you were already doing and having, and just even knowing to call you because you had been doing deals in those markets. So don't overlook the fact that, hey, you're building kind of a track record. And, we talk a little bit about personal branding. That has nothing with advertising or marketing or podcasts or anything like that, right? But you had purchased assets in those markets. You had executed on those assets that you purchased. You built a personal brand where an opportunity came up in those markets. They said, hey, let's talk to Ben. Let's see if Ben wants these. And I think that is really, really important for us to keep in mind is that we're always working on our personal brand and what people think of us. So try to be proactive with it. Make sure people know what kind of deals you're looking for, which markets you're looking to invest in, the sub markets, the types of problems you're looking to solve, so you can be one of the first phone calls, as Ben just alluded to. So
And
Ben, yeah, go ahead.
I can't emphasize enough. Everybody's a salesman. You're always selling yourself, and you have to be likable. People need to like you to want to give you business. And this kind of go into a second portion of my kind of, is that I've seen a lot of people be penny wise, pound foolish in the beginning. And it's normal when you're on a very small budget, you're pinching pennies. But if you differentiate yourself, let's say with the younger brokers, and you say, you know what, like, I'll pay you an extra quarter point at close if you give me the first call. Like, that has helped me secure some of the best deals I have ever, and that quarter point is worth so much more than the quarter point at close that I paid them on top of their fee, to bring me the first deal. And just to be likable and socialize, and just because people, they almost will do business with you even if you're giving them less money, if they like you.
It's so important to make sure you stand out, build a positive reputation, and be likable, someone easy to do business with. That's going to take you really far. Let's talk about that transition, right? So up to this point, we talked about, what led you into kind of going all in on real estate. That's where you're at now. Talk to me about kind of some of the things you experience with that transition and obviously scaling up your business.
It was not easy. It was difficult. I had to take a big ego hit, going from working at a hedge fund, and just everything that kind of in Manhattan that goes along with that, to moving my office to Westchester. And it's lonely being an entrepreneur, going out on your own. Your friends don't really understand the pressures. Your former colleagues uh, don't necessarily want you to fail, but wouldn't be, in my opinion, in my case, wouldn't have been uh, too disappointed if I did not have success.
Can you
And
elaborate on that, Phil? Because I think there's something deeper there that may resonate with some of our listeners. Can you just explain a little bit more about why you felt some of your colleagues didn't want you to succeed, or at least wouldn't worry too much if you did fail?
well, yeah, I think it's really more a reflection of them, of how they look at themselves, and it's a jealousy thing, and the fact that I always say you're never going to generate real wealth on a W-2. Even if you're making great money working for someone else, you're still working for the man. And for me, one of my another main reasons why I left is I just I just really valued I knew I at that point I had honed my skills. I had analyzed everything from tribal casinos to coal mines to dry barges and tugboats operating up and down the Mississippi and Ohio rivers. I mean, traveling all over the country, and I knew the model for success, and I knew and it's not rocket science. It's just it's a cash flow. It's a value based on future cash flows, and basically how what I like to call in my case the stigma arbitrage. These buildings in Mount Vernon and Yonkers were not sexy. They were not good-looking buildings. Structurally, they were sound, but from the outside, it's not something you want to bring a new girlfriend, on a road show saying, "Hey, look, I own this. Hey, I own that." It's not a skyscraper in Manhattan. But I have found that the most money and the best way to consistently generate alpha is through shunned, overlooked, misunderstood, or unsexy assets.
Yeah, you said stigma arbitrage. I love this that terminology and just thinking about it that way. You talk about investing in unsexy assets, right? You started there talking about, hey, your colleagues, and maybe there's a sense of jealousy. And I think it makes sense, right? If you're on, you're on Park Avenue, you're in the hedge fund world with a lot of, smart people, great financial people making good money. And when you go out and you leave that world to go do your own thing, I think most people ask themselves internally, oh, that's interesting. I wonder if I could do that. And maybe that voice in your head shuts it down immediately and says, "Oh no, that's too risky, right? This guy's probably going to fail, and when he does, it's going to validate me staying in my position. But if he goes out there and crushes it, then I'm going to have to sit in the mirror and say, "Man, well maybe I should have done that. Could I do that? I don't know. Can I do that?" And it forces kind of an internal reflection that is sometimes scary for some folks, right? So it's not that, yes, it may be complete jealousy for some people, but I think more likely it forces people to reassess the decisions they're making in their own life and their own abilities. And people don't like that. That's why people don't, they like status quo and they want to see people fall in line. And when you see someone break off and strive to reach their potential, a lot of times the people who knew them or are close to them, they're not the champions you would expect them to be. And you probably find people who were supporting you that were not the people you expected to support you. And that's just, what happens when you go out there. I tell people all the time, like when I first got into this space, I thought a lot of my former colleagues would partner up with me and we would do business together. And nope, nope, didn't happen that way. And what I realized later on in reflection was it was the same kind of thing. It's like they certainly don't want me to fall on my face, right? They want me to be able to take care of my family and things like that. But they don't want to have to sit and reflect and think about the decisions they've made and have me be a representation of, maybe dreams deferred and things like that. So it's something psychologically. And I think if this is something you're dealing with, it's a look in the mirror and ask yourself and also go through that worst case scenario. I mean, if the worst case scenario is you go back and get a job, it's not that bad. Take the leap, especially if you're younger in your career and you have flexibility. But these are the things that you certainly have to be mindful of. Then you started getting into something that I want to drill into, right? So you are investing in kind of the luxury RV space, and you talked about really kind of finding this niche of creating wealth by focusing on kind of stigma arbitrage or these assets where they have kind of a bad reputation. Just talk to me more about kind of how your investing philosophy has evolved and what kind of led you down the path of RVs.
Yeah, so I mean, at the hedge fund level, I was taught to be a contrarian. When everyone's running one way, run the other. That you never make money by following the herd. Buy from pessimists, sell to optimists. Um, and that has really stuck with me. And that's really what led me to the RV space, which I say this very carefully, I think represents one of the greatest real estate opportunities opportunistically right now of our generation.
I love it. Tell me more. Why do you think it's such a great opportunity?
Yeah, so I'm a very numbers-based statistical guy. So there's about 11.5 million RV owners in the country. Okay, over a million of which live in their RVs full time. There's only 750,000 pads in the entire United States. Uh, of those, that's across 16,000 RV parks. The average age of which is 45 years old. 90% of which are single owner mom and pop operators. And post COVID, so every year on top of that, about between 4 and 500,000 new RVs are sold. And the average age of a new RV buyer is down to 32 years old,
Wow.
which tells you a couple of things. One, it's very likely that they're a new buyer. They're a first-time purchaser. It's not just someone who's one of those 11.4 million that's just buying, trading one in and buying a new one. But it's also telling you the demographic is drastically changing in who is driving around and who is living out of these things. I mean, we post-COVID, there has been a structural shift in American society. It used to be uh, get married and plow all your money into a single family home and have kids, and that's the way you're supposed to live. There has been a not cyclical, as cyclical would mean it would be returning to the way it was, structural, which is a permanent shift that millennials uh, are really valuing experiences more than materialistic items and freedom and something called YOLO, or you only live once. And so in these RV parks, it's not a lot of people, that a lot of the tenants are in their mid 30s, IT consultants with 4 computer screens. It's not who you would think they are. And kind of going back to just I mean, the glaring supply demand imbalance. On top of that, you have these mom and pop owners that don't have the money or the wherewithal to upgrade their facilities to the level that the new demographic of RV owner wants. And I'm talking very simple things here. So, for example, 70% of RV parks do not take online reservations. You have to call physically, and 65% of which times you call, they won't pick up. Most don't have Wi-Fi. Wi-Fi is the most important thing on top of safety and a few other kind of really go to really neat basic needs. You need amazing Wi-Fi, and then on top you throw in some pickleball courts. You put some lipstick on it. You pave the roads, new signage. You put a gym with some Pelotons in it, and it's unbelievable the premiums you'll be able to. And also these mom and pop single operators, they're terrified of vacancy. So let's say they're charging 400 a month per pad. There'll be someone down the street getting 700 a month per pad, but because they're so terrified in any temporary bump in vacancy and a cash flow dip, they will not increase their rents.
Yeah, I mean, what you're getting at too is similar to many multifamily owners, the old mom and pop, right? Because for them, it's not about optimizing performance. It's about ease of ownership and ease of management. So they don't want to have those vacancies because that means they got to work, right? So they'd rather just keep it at $400 or whatever number it's at. So people pay. They're not hurting necessarily financially because they probably had it for so long and it's now positively cash flowing. But there's definitely a big upside opportunity as investors. And you talked about just some of the big gaps as far as what's changed, particularly since COVID. So over the last, 3 or 4 years here, where that mindset has shifted, right? So it's younger demographic, not as much access to Wi-Fi. 70% don't even have an online reservation system. Even when you do call, most of those are just ringing and ringing and ringing and going to voicemail. So you're not necessarily getting someone live who can help you right away. So there's a customer service component to this. Then you got into the amenities, right? So getting into whether it be pickleball courts, gyms, making sure that you have something that reflects the lifestyle that many of these people are looking to live. That's a key opportunity. And this is something that you've identified for you and your firm, which you're going out there and identifying these opportunities now. What does that market look like? What's the size of the opportunity and kind of what is your business plan as you go out and continue to grow and acquire these kind of assets?
Yeah, so now that we have proof of concept, and I've scoured the market. I have chosen the Southeast, and more specifically Harrison County, Mississippi, Mobile County, Alabama, Baldwin County, Alabama. So each side of the Alabama Bay, and a little bit on the Panhandle of Florida. Um, if you look at Florida and Texas, the RV park market there is already somewhat saturated, but you see everything starting to move east from Texas and west from Florida and converging on this Louisiana, Alabama, Mississippi area. And I believe that area represents like the Gold Coast and the last Wild West of opportunity set in this RV set. So, for example, like mobile home parks got really big like 5 years ago. Like 10 years ago, they started to get established. Known brokers started going into them specifically, but the financing challenges were tremendous. You could not finance a mobile home park 10 years ago. About 5 years ago, that's changed, and nowadays, the valuations of mobile home parks has increased so dramatically that they they offer obviously certain benefits compared to multi, in that you don't own the actual mobile home park, so you just own the land, so you're not responsible for the repairs and maintenance. But from like a cap rate perspective, they're trading almost even at a premium to multi. RV, the financing is so behind where it should be, and it's not. Another thing that a lot of people aren't aware of is the U.S. Department of Agriculture will lend to you an individual, and you can get an SBA loan to buy an existing or build a new RV park at a competitive rate. It's a little arduous to get, but there's even banks that do bridge to USDA or bridge to SBA. And it's really just about getting yourself out there. And I mean, I fly into New Orleans. I've driven from New Orleans to Pensacola and back probably 35 times. And I have brokers on the ground driving from RV park to RV park every single day. Just establishing relationships with them, hoping eventually that they will be willing to sell, and I will be that first call when they sell, due to the factors that we discussed previously, just
Yeah.
likability and not being penny wise and pound foolish.
I like you bringing it full circle, right? Understanding how to identify the opportunity, recognizing that, hey, most of Texas has probably been saturated, certainly large parts of Florida, but really that land in between, right? Mississippi, Alabama, the panhandle of Florida, there's some opportunities there, and that's where you're searching. And you've got brokers on the ground right now. They're looking. You yourself are out there driving those areas and just reaching out and staying and checking out what's happening at some of these different RV parks and recognizing how the financing of it has shifted and changed and will continue to shift, and why that's going to be an opportunity for investors like yourself moving forward. If folks want to learn more, they can check out your website, rwcapitalinvestments.com. I think there's definitely going to be some opportunities in that space. And the more you're prepared for it, the more knowledgeable you are, obviously that positions you to be kind of the main go-to for those opportunities. Um, when you look at kind of the RV landscape, I know you talked about the difference between structural changes and more cyclical changes. Um, for that person who maybe feels that what has happened with the rise in RV and, work remote, work from home, that kind of environment, which I think obviously has led to the rise in RVs, that person may be a little bit more pessimistic or cynical about, oh, well, is this really more of a permanent shift, or is this still kind of a trend that may kind of phase out over the next couple of years? What would you say to them?
I mean, just go back to the numbers that I originally stated when we first started chatting. 750,000 RV pads, only 8 to 12,000 max are built a year, and 400 to 600,000 new RVs are sold every year. There's a 1.5x, there's 1.5x, 1.1 million people live in their RVs full time, and there's only 750,000 pads. So that leaves 10.4 million RV pad owners, or RV
Facts.
owners without a place to go. And and I view this as an opportunistic opportunity. I'm raising a 35 to 50 million closed-end private equity vehicle to go out and purchase $200 million of these assets. And my goal is to scale to 5,000 pads in this micro geographies in the next 36 months and sell to a Brookfield or a KKR, or maybe a REIT. But economies of scale is very important. And also, I can't emphasize enough for the listeners how important property management is. Boots on the ground is everything. So coming from like a private equity background where I was betting, investing on companies ran by other people. And I view real estate in the same way. My property manager is my CEO. I am the chairman of the board of directors above him, but he is the guy on the ground making it happen. And if he's not, and a lot of people, like going back to the penny wise, pound foolish, will want to just get property management for the cheapest they can, and just not even think anything else more. I am the opposite. I want to pay a premium. I want him to have equity in the deals, and I want to highly incentivize him that if he performs well, he will be compensated accordingly for that performance. And I have seen a tangible, a factual just delta in the performance of my parks with my property management style versus traditional.
I love it, man. All right, let's go to our round of insights here. Give me a failure or an apparent failure that set you up for later success.
Yeah, so the first time I tried to buy a building, I went hard on a deposit, and I was young. I didn't have a lot. I put a $50,000 hard deposit down, and the Signature Bank fell through. I did not have the bank. I did not. I was over cavalier, and I did not have the prerequisite track record that they want. The loan didn't work out, and I lost the deal. And I was very discouraged. I had an FU mentality about real estate. I should just stick to what I know. But I stuck. So that was, I mean, in a sense, that was a big loss for me at the time, and it was emotional, and it was very upsetting. But I internalized everything. I said, like, this is all my fault. I did this wrong. I should have done that. You coulda, woulda, shoulda. but I was able to surround myself and start networking with other real estate professionals that were farther along in their careers, that were able to really get me back on track and talk me through what had happened, and to say that it's not uncommon, and to validate, and to just to keep me on the course that I was. And that failure initially ended up really acting as a big motivating factor in me trying to scale quickly afterwards.
Give me a digital or mobile resource you recommend for investors.
A digital resource or mobile resource. I think that I think LinkedIn. I don't know. LinkedIn. I think LinkedIn is phenomenal if used correctly. I rely on it all the time. I'm sent deals on LinkedIn all the time. I have like 5,000 followers on LinkedIn, and I don't have anyone working my LinkedIn profile. I'm just active, and I'm posting about current events. And if used correctly, I believe it is the most valuable software out there to help you grow in any professional arena you want.
Give me the book you've recommended or gifted the most in the last year.
Yeah, it's called Investment Banking by Josh Pearl. He's a good buddy of mine. It's given out at Harvard, Yale now. It was my Bible when I was on the buy side. It just in very simple language, just explains how companies are valued, how assets are valued, how they're financed, and all the inner workings behind it with the banks and insurance. And even though it's not a real estate focused book, I think it's a really good base knowledge to start. And then one more I'll throw out is How to Build a Real Estate Empire Using Other People's Money.
All right, two good books there. All right, give me a daily habit that helps you stay focused on your goals.
So I have to go to the gym every day. If I do not go to the gym and get a good sweat and really work out, I'm scatterbrained. I'll have trouble sleeping. I'm not thinking correctly. I need to make it to the gym every day because and I need to eat healthy because healthy body, healthy mind equals your best self.
Give me your number one insight for investing in RV parks.
I'd say mom and pop, just target mom and pop operators, and be persistent and be likable. And even if you have to I'm from Manhattan. If you have to be a chameleon and throw on your Southern charm and dress different, whatever you have to do to befriend these people, do it and get them to trust you and sell you their parks, and be creative. Offer them 20% of the equity even upon sale, that maybe burns off over time. Or be flexible, be creative. It's not just so black and white as just just acquiring their baby, because this is their baby. It's been their family's baby forever. Be sensitive and really just try to be open to anything. They're more open to a lot more than they think they are.
I love it, man. Great tips there. Let's go in a different direction. You mentioned being in Manhattan. Give me your favorite place to grab a bite to eat.
Oh God, probably be Rayo's Italian.
I love it, man. Sounds like a great option there. You said a couple things that stood out to me. One, just understanding the investment world, coming from the buy side, really focusing on what a great opportunity looks like, not in the equities, but really these unique opportunities. And you said that, hey, one thing you really learned was looking for these properties or these investments where there's a stigma arbitrage. So not necessarily the prettiest, sexiest thing, but something that's going to prevent your typical investor from shying away from it, even though they're making good money. I think it's a great way of just thinking about opportunity. You also said something I wrote down, which I thought was simple, but still really important. And is that you want to, sell to someone who's optimistic, but you want to buy from someone who's pessimistic, right? That's going to create kind of the best opportunities for you. Getting into the RV space, giving us a couple data points there, 11.5 million RVs out there, only 750,000 pads. The average age of the buyer for these new RVs is down to 32, which is really, really low if you don't know. That's a really low average age. And when we talk about the pads, 65% of them are, I'm sorry, the average pad is 65 years old, and 90% of these pads are owned by mom and pop investors. So definitely opportunities where you're not competing with necessarily these large institutional investors. They don't have the technology or some of the infrastructure there. So it does take a little bit more work working with these brokers and finding these opportunities, but definitely could be an opportunity for those who are looking to invest. Again, if you want to connect with Ben and learn more, you can check out his website, rwcapitalinvestments.com. We will link to that in the show notes. Ben, thanks again for coming on the show today and being a great guest. We look forward to staying in touch with you, and I hope you have a great day.